Hey, it's amazing how all of these magic things work. I've got such a tremendous support team and staff and associates here at the firm. Excited to be with you here today. And let's get right into it. We have a lot to cover. I just wish that things were a little bit more exciting and a little bit more challenging. I mean, we're just living in such boring, just quiet. Oh, no, that's another decade. Never mind. Woo! I mean, every morning we wake up and by the end of the day, it's like, what happened today? So hang in there. All right. So we're going to talk today about what's going on in the markets in our update. And then we're going to talk about our topic of this month, specifically just a little quick update on annuities and that type of thing. June is Annuity Awareness Month, if you didn't know that. And so we'll get into that. All right. So we're going to discuss a little bit about inflation. Are we in a recession? What to expect from past histories of recessions, etc. What have the markets done this last month? Well, I think you're all paying attention to that. What are annuities and what's their best use? So let's just jump right in. Before we get into this stuff, I want to back up just a second and say, you know what? What's really important in your life and in my life? And I'd like to have us focus, maybe write these three questions down on a piece of paper, and I'd like you to just think about these a little bit. We'll get into the financial discussion here in just a minute. I just want you each to get a piece of paper, write down these three questions. And ponder on that a little bit and talk to your spouse, your significant other, your family about these three essential questions. What would you do if you had all the time and money in the world? That's an interesting question. Number two, how would you live if you knew that you only have 5 to 10 years left? Interesting. Priorities. And number three, what would you most regret if you die, or as I call it, graduate tomorrow? So please, I encourage you, give those three questions some thought. I think that would have a very positive impact in each of our lives to think about that. Okay. All right. So let's get into the discussion financially here. Federal Reserve. We all know they're increasing interest rates. At the beginning of this year, the rate was near zero. Now it's in that 1.5 to 1.75 range. At the end of 2022, this year, the Fed is forecasting that rate is going to be in the 3.25 to 3.5 range. So about double where we are today. They've got 3 or 4 more meetings the rest of this year, and they're being very aggressive about interest rates. At the end of next year, current forecasts are that the rate may be increasing even further, up to about 4% or so. Oops. So this recent increase this month, June, where they declared the 0.75% all at once, that's the largest increase since 1994. So inflation issues are getting the attention, and they're doing what they do, and that is increasing rates to try to slow that down. But there's lots of residual potential problems there, so we got to be aware of it. Yeah, so July, they're going to have another meeting and so on and so forth. They might do another 0.75 in July. We'll wait and see. But that's what they're looking at here through the rest of the year. So let's talk about recession and what we call stagflation. We're all familiar with the word inflation, and we're hearing about it. But what's stagflation? And certainly stagflation is where costs remain high, but we don't have the resources of the money to pay for it. So we're stagnant. We're in the early stages right now of what could become an extremely severe recession. So we just eyes open. No, the sky's not falling. We're not saying panic, but let's be informed and educated. Costs are stubbornly high for things we need most. I think we can all attest to that. They're really crazy. And yet growth is very rapid, it's slowing. It's rapidly slowing because of the Fed's actions. So that's where stagflation comes from. It's all exacerbated by the massive financial bubbles that have been created and may be on the verge of deflating, boom, popping simultaneously. Wow. Now remember, markets are cyclical, right? What goes up eventually comes down. And so recessions are inevitably followed by periods of growth. Human nature swings back and forth. I mean, these are all things that we just need to be aware of. We're experiencing right now extremes of greed and fear over and over. This has been going on for the last 20 years plus, in what I call herd mentality, okay? And this is where everybody does what everybody's doing based on emotions. We all go running this side, and then we all go running this side. And those things impact the economy. And that's what we're dealing with right now. And it's all motivated by emotion, the extremes of greed and fear, despair. Each Fed chair since the year 2000, so the last 22 years, has been enacting increasingly aggressive policies, the go big or go home kind of a mentality. And so the greed has created extreme valuations on assets. There's assets out there that have gone to crazy levels, absolutely crazy levels. And then fear is creating some extreme lows. And we've seen that volatility through those emotions. Look, there's been no major market correction for the past 13 years. We had that little COVID blip in 2020, what I call the reaction. It wasn't a correction, it was a reaction, March, April of 2020. But we have not had that correction for 13 years. And that's primarily because of the successive rounds of unprecedented intervention by the government and by the Federal Reserve. Well, what goes up must come down. So those actions have led to inflation, massive bubbles in housing. Anybody aware? Yeah, hello. If you've been in the housing market at all, it went out of control. The last couple of years, it's been building. Have we peaked? I don't know. I think there might be some easing in the housing area. Corporate bonds, way overvalued in many situations. Commercial real estate, stock market, all-time highs in 2021 in spite of COVID and other crazy things going on. Just crazy exuberance, irrational exuberance, you might call it. Tech, speculative. Boy, oh boy, who hasn't heard of cryptocurrency? Woo! Well, again, that's an example of what's going on with greed and just crazy emotion. So be careful with that. COVID combined with that slowdown that started in 2019, that's why we are looking at and using that word recession and stagflation, et cetera. You know, the government printed over $5 trillion out of thin air, what we call a kind of like a helicopter drop. All this money got printed and they just dropped it right directly to the public. And they expanded their balance sheet more in 1 year than all the prior 108 years combined. So that's an interesting dynamic history, as we say. We'll look back on this and see what that really meant. We're feeling it now. And this has unleashed tremendous amount of greed and speculation, driving all investments and assets to new heights, despite all that COVID issue and supplying us as such. But we're now seeing things, and we'll see how it goes. Inflation rates not seen in over 40 years, okay? Now, public consumption drives over 70% of our economy. And right now, we're seeing a rapid decline because the consumer's getting crushed. So what do we do? The Fed has this mandate where they've got to stabilize prices, and they're clearly behind on that right now. But so they have to take action. And of course, they also want to make sure we have optimal employment. We show great low unemployment rates, but is that really true? Figures lie and liars figure. So be careful with some of this data that you see. Right now, there's immense political pressure to get pricing under control. And so they're probably going to have to sacrifice number two to get to resolve number one. because it really can't do anything to resolve the supply chain issues. So they may break the back of the consumer, raising rates until the economy hits a wall, and that would result in a deep recession and massive layoffs. Otherwise, stagflation and other types of things are going to get ever so either accelerate into the wall or jump off a cliff type of thing. And so with all of that said, you're going, good grief, Lynn, thanks for all the positive news, man. Look, and this is not just here, by the way, folks, this is global. These types of things are occurring in Europe and Asia as well. So yes, what do we do? Now, by nature, all of you that know me, I am a very optimistic and abundance-oriented person. And I put that in writing even. The sky's not falling, but this is tough love. You know, I like using the Joe Friday, if you remember that on the TV show Dragnet. Just the facts, please. Just the facts. You know, it was very, but I'm just sharing facts. I'm sharing information. Our job is to educate, and you have us as a resource to give you straight information, and we value that relationship, and we're gonna talk straight with you. So I would rather be overly conservative and pleasantly surprised than overly optimistic and devastated. So anyway, now what? There's the, okay, what do we do about this? Let's get into some information. I like to use the analogy of all hat, no cattle. Be careful with where you're investing and decisions that you make. There's lots of pitches out there that are all hat and no cattle. Do your research. Trust but verify. You know, in the sports analogy, you may have put some wonderful people on your team, and that's a good relationship, and you train and you work and you practice and you do what you do. But you know, even a great player is going to throw up an air ball once in a while. All right. So what do we do to that player if they throw up the air ball? Do we bench them? Do we fire them? Or do we encourage them because we know what they're capable of doing and how they can help all of us as a team win? And that's what I want to focus on in our relationships, is that, and of course, there's the other overrated that people will yell in a crowd at somebody that's a star player and throws up a brick or whatever. So be careful with those analogies. I was talking to a client yesterday. One of their children is a sports psychologist and coaches primarily professional golfers. And boy, you talk about a mental game. Well, investing is a mental, very emotional game. So we have to, perhaps we need some psychology. Perhaps we need some coaching to hang in there. Don't overreact. But yeah, don't bench your top players. You know, pay attention, know what you have, know what their talent is, look at their past history, and don't just put them on the bench when they make a mistake or two here and there. The grass is always greener on the other side is another analogy, but stick to what you know and trust. And that's what we do in our investment firm here with folks. We do a lot of research, as do our partners, in what we do and where we invest. And so we know that in the long term, we feel very confident in what we have on the team. And if we see a problem, we're going to correct it. We're going to get psychology going. We're going to get training going. We're going to get things dusted off and move forward. So believe in those yourself, believe in that past history and trends. You know, do I stay or do I go? I mean, that's certainly your decision in all aspects of your life, financial and otherwise. So what do we do? What are some action plans on how we compete with or deal with this current scenario? I bonds. Write this down. If you have not looked at or heard about I bonds, you need to know about them. They are a direct investment with the government. You go to treasurydirect.gov right there on your screen and set up an I bond. Right now, the 6-month rate, they declare that rate every 6 months. The rate is 9.62%. Now it's every 6 months. So if you get in now, that 9.62, half of a year is guaranteed at that rate by the government. They will declare the new rate for the next 6 months in November. Where do you think inflation, this is linked to inflation. Where do you think inflation's going? You think it's going to come down dramatically anytime soon? I don't think so. And so while it's staying up there, these I bonds are a great resource to put some money away. Now, there's some restrictions here. You can only put 10,000 per person per calendar year into that account. If you have a company, you can put 10,000 in the name of your business as well as something for yourself and or your spouse. Okay. So I'm encouraging everybody. You don't have to do 10,000. 10,000 is the max. You can do 1,000. You can do 5,000. Do 500. Whatever. TreasuryDirect.gov. Set up the account online. It's backed by the federal government. It is about a 1-year wait before you can actually liquidate. Okay. And if you liquidate before 5 years, then they subtract the last 3 months of interest, which I say big deal. If I'm getting 9%, 9.6% interest, and at the end of the year, I pull the money before the 5-year period, I lose 3 months of interest. That means that instead of 9.6, I ended up only earning 7.2. Is that a problem? So pay attention to I bonds and take advantage of those things currently. That's an action plan. Number 2, bankrate.com. If you have not looked at that, go look at it. This is a high yield savings account opportunity. What's your local bank paying right now on your savings accounts? With the Fed having raised rates significantly, banks have not hardly done a thing to follow those rate increases. So take action. Link your bank, your checking or savings, to a high yield account. And right now they're up at about 1.25% interest. It's FDIC insured, 100% liquid. You move money back and forth between your bank and the high yield account. It's just with a phone call or a keystroke. And take advantage of that. Questions on that, talk to any of our advisors. We can help you research that. Many of our clients are doing this already. Share this with your friends, your family. You've got to get some kind of growth on those savings accounts. All right, let's do some analysis on some charts. Okay, so recession. Oh my gosh, what does that mean? Here's some history, and this is a busy chart. You might want to get your camera out and take a picture of the slide so you can look at this a little bit more in detail. But what we're doing here is we're looking at, okay, going back to all these recessions, how do equities perform around recessions? Okay, on average, stocks perform worse 1 year before a recession than during. And then in the 2 years following, price returns were positive 82% of the time. So what I'm trying to share with you here is just go here to the bottom, okay? And if we look at during a recession, okay, gosh, in 07, ouch, we got hit hard. And I don't know, we may have that same type of thing going on. Right now, we know that, gosh, Gage was sharing these numbers with me updated this morning. The S&P 500 has hit so far this year negative 23. The NASDAQ has hit negative 32. And the Dow has hit so far negative 18. So here's some numbers here of what's going on during a recession. And I'm saying that we're there. We're kind of in the beginnings and how long it's going to last and that kind of thing. So 6 months before, 12 months before, 6 months after, 12 months after. What I want to focus here is that, okay, the average return 6 months after a recession, 82% of the assets were positive 6 months after this recession. 90% of the assets had positive gain after 1 year of a recession, after the recession ended, I should say. And then 2 years after, we maintained about 82% of assets. And look at that average return, 16 to 20%. So what I'm saying is, again, don't panic. In the middle here, be careful, but don't panic because you're going to miss out on what comes after the recession. Here's another interesting chart that shows every year since about 1980 where the market went high to low during that year. During that year, where did it go? Because markets, are up and down, right? They're up and down. In 1980, during that year, the market during that year was down 17%, but it ended the year up 26. All right, that's how you read this chart. So you can see during almost every one of these years, the market was down at some point during the year. And look at how many of those years ended up positive. If we jump, we try to time the market, that's disaster, okay? Your advisor can help walk you through it, educate you. And like I said, you got star players on your team. Don't bench them. Enjoy the talent that will come long term. We might lose a few games here and there, but lose the battle, win the war type of thing, whatever. We can go through that. Let's look at 2007. That was a tough one. -38. It was down as much as -49 during the year. It ended down for the year, -38. That happened again in 2001. We were down as much as 34. It ended -23. You see that? And so far this year, here we are. Oh, let's go last year, just real quick. 2021, we were down 7 at some point last year, but we ended up 29. If we were down 7 and jumped and went to cash and quit, we lost out on some potential return there. And this year we're down 20. We've been down as much as 34. We've been down as much as 34, but right now we're down about 20. So give that some thought. Don't panic, don't overreact. But again, what goes up does come down. Things are cyclical. Just understand the history. How long do recessions last? How long do bull markets last? Real quick, bulls typically last about 2,000 days. Okay, that's our history going back into the 60s. Recessions or bear markets, well, they last about a year and a half on average. I don't know. We've had some that lasted almost 3 years. We've had some that lasted just half a year. Look here in the 60s, it lasted 240 days. 70s, 74, had some rough times there. That's where we had some stagflation, by the way. That's kind of maybe what we're repeating here 40 years later, right? Let's see here, 34% there, only lasted 100 days. Here's our 2000 and 2007. And here's our COVID reaction where it was down and up within 33 days. So I don't know, but I just want to encourage everybody and remember that bears don't last forever, but they are going to happen. So be smart and understand, use history. Okay, now that's it. That's it on the market. Okay, oh my gosh, if I haven't lost you already, hang in there. So we do in our firm, as you know, we talk about safe money, right? We use green money, yellow money. We talk about red money. And I'm going to focus just on green here for the next 5 minutes or so to just give you a quick update on annuities. Look, in 2024, the United States is going to have more 65-year-olds than ever before. I turned 65 here this past week. So I've got my Medicare card. Everything's great. So I'm in that group of 65-year-olds, and many of you are as well. And annuities offer protection from risk and can provide lifetime income. That's the proper use, safe growth, lifetime income. And it helps you protect your gains and avoid market losses. Do we say put everything in green? No, but it better be part of that foundation that helps you sleep at night. Opportunity in the other areas, be educated on. Tax deferral with annuities, it manages risk. It's a pension. You realize that in 2020, only 4% of employees can count on an employer pension. Only 4%. You have to create your own, and we use annuities to do that. Typically, there's no real fees in annuities, so you avoid a lot of hidden unknowns that might be exposed to in the markets. And innovation. Today's annuities are not your grandfather's annuities. New models can provide much more accumulation and bigger payouts than old models that might be 10 or 15 years old. We're seeing a lot of our clientele. Look, we've been working with annuities for 20 plus years in our firm. And, those old models were good for the time, just like cars. Technology has improved since then. And these new models, these new cars have wonderful new technologies that didn't even exist 20 years ago. So trade it in and pick up those bigger accumulation and extra benefits that are now available with newer chassis than what was available on chassis, 10 years or further, 5-10 years ago. All right, let's see here. Myths about annuities. Annuities are expensive and have high fees. Fixed annuities typically don't have any direct fees unless you opt for additional features like enhanced income or death benefits or something. There are surrender charges, however. If you cut and run during the surrender period, there could be a back-end charge. But other than that, there's no fee unless you choose to enhance benefits. Typically, the vesting period, surrender period is about 5 to 10 years. And of course, there's limited liquidity during those times. And they're typically fully liquid at death, or if we have a chronic illness or terminal or other types of things. So again, there's lots of detail, but just overview, general information. Annuities are only for people that are ready to retire. True or false? Well, look, they protect money from market volatility and inflation. So they're a growth vehicle. They're a stable asset class. That's what you can look at them as a asset class to complement your other investments. So no, it's not just for people that are retiring. It's an asset class. Too complicated. Well, they can be a little bit crazy. Get the information, get some guidance from the advisor, do your research. Don't ask McDonald's if Burger King makes good hamburgers. Go to Burger King and figure it out yourself. Oh, annuities are all the same. Annuities are bad. There's a lot of that goes on from various organizations. What's the agenda? What are they trying to do? Trillions of dollars are going into annuities. Some of the brokerage community doesn't like that. So just understand the dynamics behind that. Most people don't understand the difference between variable, fixed, immediate, or fixed index annuities. It's very easily understood. Just get the information and don't just knee jerk based on what your brother told you or your work associate told you or what you heard on the radio or TV or the internet by folks with their own agendas or ignorance. Get the information, make your own decisions. The annuity company keeps my money if I die. Well, that's absolutely false in almost all situations. The only exception is if somebody has an immediate annuity that they elected a life-only income from. And we rarely ever recommend that option. I think in my 25-year career with annuities, I've recommended that option twice. And when I recommended it, I had all the beneficiaries and everybody that could have been entitled to monies sign off on a letter that says, yes, we understand that if mom or dad passes prematurely, that money is poof. So again, the only time that the beneficiaries do not receive money is if they elect a life-only option on a payout, which we never, ever, ever recommend, and go kicking and screaming. I've done that, as I said, once or twice. All right, so too complicated. Again, get your information. They're all the same. No, they're not. Avoid, as a general rule, avoid variable anything. That's laden with fees and risk, and it's lining the pockets of the advisors and not doing what it needs to do for you. Again, as a general rule, get informed. The annuity keeps our money. We talked about that. Lifetime income can be created in other ways. Okay, I'm happy to hear what those are. Okay, Social Security. Okay, that's income that we count on in lifetime, and we all know Social Security has some issues. It's cracked, as we say, not broken. It's cracked. Needs some reform. Pensions. Well, pensions typically do, but have pensions ever gone broke? Yeah. So be careful with that. But annuities are one of the most effective ways for 100 years plus of providing guaranteed lifetime income to those that own those investments and use those in their planning. The big three: Social Security, pensions, and annuities, for peace of mind and not outliving your income and having guaranteed and high, security income. All right, everybody should own an annuity? No. Wait a minute, we're promoting annuities here, and now you're telling me not everybody should have one? Yeah, it just depends. They don't fit every situation. So that's enough of that. Real quick, what are the annuities paying nowadays? This is good information. There's some short-term annuities that we use as a bank alternative. 1 year guaranteed at 1%. Well, that's not very attractive right now because banks, I just told you, could get us about 1 to 1.25 on those high yield accounts. A 2-year, we've got a carrier out there that's paying 3% guaranteed per year. Again, no risk, no fees. Okay, no market risk, no fees. It's a 2-year deal. If you cut within that 2 years, there's a back end charge. Okay, that's the way annuities work. But for rainy day money, pay attention to that. 3% a year, that's pretty good. A 3-year carrier, we've got a carrier out there paying 4% a year. Now, and then there's a 4-year and a 5-year. Look, we just talked about how the feds are going to be increasing rates. I don't know if I would go to a 4 or 5 at this point. I might do a 2 or a 3 because then I can renew it for when the rates have gone up again and get another maybe quarter or a half a point 2 or 3 years from now. We'll see. But be aware of that. And then, of course, as always, restrictions and exclusions apply. Get the brochure, talk to an advisor, get the information. And you know what? I just noticed on my time clock, I'm at my 30-minute mark. We're done. Boy, that time went fast. Here's the disclosure. As always, this is who we are, what we do. And we enjoy being a resource. We look forward to seeing you in our future updates and our weekly OWA live sessions. As always, these are on our website. You can look and get a repeat on this via our YouTube page. Until then, stay well, be happy, be informed, and fasten your seatbelts. Until next time, take care. Bye for now.